Hey guys, Steve Ferguson here, Thrive Mortgage. Hope you're having a great day today. You know, I keep getting asked to do a video about rate buy downs and to go over the specific details of what a rate buy down looks like. So today's the day. We're going to go over, number one, what's a rate buy down? What kind of rate buy downs are there? How do you determine the cost of a buy down? And then, is it really worth it, or should you consider something else? So bear with me on this video. It's going to be a longer video because I want you guys to have the right information, but we're going to go over this in detail. So what is a rate buy down? A buy down for an interest rate means that you are spending money up front, part of your closing costs, to buy down your rate from market to something lower. Now there's two strategies for rate buy downs. One is a permanent rate buy down, which means you pay one fee and your rate reduces to this amount and it stays that amount for the life of your loan. The other rate buy down is what's called a staged buy down, like a 2-to-1 buy down or a 1-to-1 buy down. So what that means is you pay a fee up front and your first year's rate is substantially lower. And then your second year rate is higher. And your third year rate is when it finally fixes for the term of the loan. And there's different variations of that type of loan product as well when you're doing staged buy downs. So let's talk about buy downs in general. So is a buy down worth spending the money on to get you a lower interest rate? Maybe. So let's do some math. I'm going to show you guys the screen real quick. Let me share it over here with you guys, and I'll get that in front of you here in just a second so you can see what a rate buy down really looks like. So first of all, I'm going to share my screen so that way you've got it. You can see it right here. All the happy math that I have going here. So first of all, let's just assume a purchase price of $350,000. Now, we've got a down payment of 20% with a loan amount of $280,000. Now, here's the buy down. This is a permanent rate buy down, guys. So the market rate, 7.625%. So let's just assume for argument's sake that that's today's interest rate. Your principal and interest on this loan amount is $2,016.50. So let's assume you want to spend 2%, which is $5,600. That's 2% of this loan amount to buy down your interest rate. And let's just assume that today a 2% buy down is going to get you to a 7.25. That's going to save you $72.98 off of this principal and interest payment. So that means it would take 6 years and 4 months to make up for the cost of that buy down. That's your break even. So the really important thing here to understand, everybody, is listen, buy downs all cost a certain amount of money. It just depends on what the rate is that day and the margins and everything else, but you always have to look at your break even, because if you plan to sell or refinance or anything like that before this break even hits, then you're spending a whole lot of money for nothing. I'm going to say this again. If you decide to refinance or sell, or your job may transfer you, whatever, in less than 6 years and 4 months, then it would not make sense to pay this amount of money for this particular buy down. Now, buy downs can be cheaper than this. It just depends on the market and in the day. So keep this in mind. I consider a buy down a good buy if it takes less than 3 to 4 years to pay back. Anything longer than that, we have no idea what the market's going to be, right? We could have a lot lower interest rates. You could be moving out of states. You could be changing houses and getting a new job, and you're already having this money invested, so it may not make a ton of sense to do it that way. So any buy down always has a break-even point. I want you to keep that in mind at all times. Now, how is this different from, say, a staged buy down? Okay, so a staged buy down means that what you're doing is, let's say the market is a 7.25 today. A staged buy down, a 2-to-1 buy down is what it's called, will put your first year's rate at 5.25. Okay, which is awesome. Sounds great. You spend a lot of money up front to get that first year's rate. So a staged buy down, they take the difference in your interest that you're paying between 5.25 and your 7.25 rate. You pay that money up front at closing and you put it into an escrow account, and the lender draws from that escrow account in order to pay your interest for you on your behalf because it's not included in your mortgage payment. Plus you're paying the cost of potentially buying down the rate permanently at the end. So it's a very expensive way to buy down an interest rate. There's a lot of builders out there who market this heavily because, in my opinion, it's an artificial way to get a lower payment for a short amount of time, and it makes it look good. So you're spending a lot of money up front to get a 5.25 the first year. Then it goes up to 6.25% the second year. And then the third year, it goes up to 7.25%, and it locks down. Okay. The problem with this is you guys may have already figured this out. You're only planning on mortgage payments for a year, and all of a sudden they go up. And then you've got them for a year and they go up again. Plus taxes can go up. Insurance can go up. Everything can go up. In my opinion, those types of buy downs set you up for failure. So I do not recommend those stage buy downs unless it's a very short-term temporary situation where you know beyond the shadow of a doubt you're going to be able to refinance that or pull cash out or do something different than what you thought you were going to do. So what happens on a buy down is there's a lot of value buying down your interest rate if you're going to stay in the property, you're not going to refinance, and you know the rates are going to stay high for a long period of time. Or if the seller is covering the cost of the buy down for you on your behalf, then great, let them cover the cost. It benefits you. So I love buy downs and the fact that it gets you to that lower payment and it gets you an opportunity to get a lower monthly payment on your mortgage. Now, what happens if interest rates are going to go down in a year or maybe 2 years? Then you'd want to look at a buy down where your break even is less time than that. If it doesn't get you to break even in that amount of time, then the buy down is not a good purchase. You do not want to get it. So make sure that whatever loan officer you're working with, hopefully it's us and we can communicate about that, does the math for you and goes over the break even and what that's going to look like. Well, guys, I hope this explains to you what rate buy downs are. Let me know if you have any questions. I hope you have a great day out there, and we'll talk real soon. All right. Bye-bye.